This podcast is for educational purposes only and is not financial advice. Welcome to the 15-Minute Investor. Today we're covering the essential intelligence you need to navigate really the next few years. First up, we're going to look at the urgent economic warning signal that precious metals, gold, and silver are flashing and what that means for the dollar.
Right. And then from there, we'll get into building out a rock-solid, diversified portfolio. We'll use some specific ETFs for both growth and for consistent income.
And finally, we'll dissect some essential trading tactics. We're talking discipline, risk management, and mastering those really tricky market entry points.
It's a crucial blend for today, I think. We're going from the big picture macro stuff, the storm clouds may be gathering in 2026, right down to the minute-by-minute tactics you need
To protect capital and profits.
Exactly. We're giving you a framework for both the long-term investor and, the more active trader.
Perfect. We're cutting through the noise to focus on actionable insights. And, right now, the financial landscape is presenting a really counterintuitive picture. The broad market seems healthy, but
Commodities are screaming caution.
Exactly. Let's start right there with what is, I think, the biggest surprise of the year. The stunning outperformance of gold and silver. I mean, the S&P 500, SPY, it's had a great year by any traditional measure. A 10% return is usually a win.
It's a great year.
But it's just been left in the dust by precious metals.
That's right. And this is where it gets really significant. Gold, so GLD, and silver, SLV, they haven't just edged out the S&P 500. They've outpaced it significantly.
Okay.
And this isn't just a little commodity bump. This is a clear economic indicator that should probably make every investor stop and think.
So what does this rally actually mean then? Is it just classic fear, or is there something more systemic going on?
It's signaling deep-seated weakness in the dollar. I mean, when precious metals perform this strongly, it's the market anticipating more money printing.
Quantitative easing. QE.
Exactly, QE down the road. The sources we looked at are specifically pinpointing 2026 as the year they expect a major increase. So this rally, this commodity rally, is the market's early warning system.
A warning about future inflation and the dollar losing value.
That's the one.
Wow, okay. That really reframes the whole conversation. So if that's the case, the sources are predicting another, 2 to 3% move higher for gold and silver pretty soon? How should an investor approach that without just, chasing the momentum?
The main piece of advice is simple, but it's vital. You don't fight this trend.
Don't short it.
Do not try to short it. Yeah, the temptation is to, get cute and try to call the top, but that's just a dangerous game with the trend this strong. Instead of shorting, you should be looking to accumulate on any short-term dips.
Okay.
And recognize this is a multi-year theme. This isn't just a momentary spike. You want to be on the right side of this trade for the next couple of years.
Got it. And just before we unpack how to build a defense against this, a quick reminder for everyone listening, links and resources are in the description below. So if the big picture threat is QE and a devaluing dollar, how do we build a long-term defense? The philosophy seems to be pivot, not panic. A market dip is expected, maybe 2026, 2027, but the message is clear. There is always a bull market somewhere.
That preparedness is everything. A truly successful portfolio is, at its heart, diversified. It has exposure to different potential growth areas.
So if one sector is down,
your assets in another are thriving.
Right.
Exactly. That mindset protects you from chasing whatever the latest hot trend is.
So what's the absolute non-negotiable foundation for every investor? Where do you start?
Broad market exposure, period. You have to own the S&P 500. You can use tickers like SPY or VO or VTI. That's your baseline. You get exposure to the 500 most powerful companies without having to be an expert stock picker. You're basically buying the all-star team of global capitalism. That makes perfect sense for stability. But stability alone isn't going to solve that inflation problem we just talked about. So once you have that foundation, what assets do you layer on top for that protection and growth?
Right. To deal with the QE and inflation that's likely coming, your portfolio needs a core growth ETF. Something like QQQ is perfect for that tech focus. Then you need the commodities we just discussed, GLD or SLV.
Any crypto.
And yes, some exposure to cryptocurrencies, BTC or ETH. But we have to be clear here. Crypto and some of these other high-yield things, they carry more risk.
Yeah.
They should only be in the risk capital part of your portfolio.
That's a really important distinction. Okay, so thinking long-term, 1 to 10 years out, where is the money going to flow when that inflationary wave really hits?
Money always flows to assets that have some kind of scarcity or benefit from major technological shifts. So that means tech, AI, software, cybersecurity, crypto, and gold and silver.
So owning these things today is the hedge.
It's how you hedge your risk against your cash losing value in the future, and it's how you position for maximum growth. Okay, let's shift gears a little. From growth to income generation. A lot of our listeners are looking for assets that can provide real cash flow, to supplement or even replace a job.
Yeah, a crucial topic.
We're moving beyond just hoping a stock hits a price target and focusing on getting consistent monthly payments.
This is a huge area, especially for anyone getting close to retirement. And we have two really powerful ETF examples designed for exactly that, for generating cash flow.
Let's start with the first one. JP Morgan's NASDAQ Equity Premium Income ETF, or JPQ. This thing promises a minimum 10% yield paid out monthly. That sounds huge. How does it work? What's the trade-off?
So JPQ gets that incredible yield by using strategies that are a lot like selling covered calls.
Okay.
Essentially, they own the stock, and then they sell options contracts against those shares. This gives someone else the right to buy their stock at a certain price, and for that right, they collect a premium. That premium is your income.
So if the stocks they own suddenly surge, you'd cap your potential upside.
Yeah.
But in exchange, you get that steady 10% income stream. Is that right?
That is precisely the trade-off. You're sacrificing some of the explosive growth potential for stability and cash flow.
And it pays monthly.
Monthly, and the sources gave an example. A balance of around $177,000 in just this one ETF could generate $16,000 a year. That's about $1,300 a month. That stability lets you pay bills, or even better, reinvest to grow your cash flow.
The second income play you mentioned was Devo, the Amplify CWP Enhanced Dividend Income ETF.
Right. Devo offers a yield of about 4.5%, and it also pays monthly. And when you combine Devo and JQQ using the portfolio numbers from the material, you're looking at generating over $20,000 a year just from those two ETFs.
Wow.
It really proves you don't have to rely only on asset appreciation for financial freedom. You can build cash flow systematically.
That's great clarity,
Yeah.
but we had to be transparent. The sources also mentioned that even in good portfolios, you have losses. They cited an unsuccessful play in Planet 13. How should investors think about those setbacks?
That example of Planet 13,
Yeah.
that's the tuition you pay the market. It's a lesson. It reinforces the most important psychological point. You are the CEO of your portfolio, and when a play fails, you have to ask why. Did you not stick to your risk limits? Did you miss a big shift in the company? The loss isn't just lost money, it's data.
Data to fix your strategy.
Exactly. It tells you to fix your strategy and make sure you have your stop losses in place for the next one. You learn way more from your misses than your wins.
Let's turn that tuition into tactics. Trading is so often described as a psychological game. What are the core discipline rules we need before we even look at a single chart?
Discipline means, first, you track your results, you journal your trades, and you are ruthless about risk management. This means two things. Protecting your capital.
Okay.
So you only trade, say, a maximum of 1% of your total portfolio on any one idea. And second, you protect your profits. You set hard stop losses. You never, ever let a $200,000 paper gain turn into less than a $100,000 profit. You lock it in.
Once that discipline is in place, then we have to deal with the market's opening moves. The trick, trap, and frustrate crew, as it's called.
Right.
These tactics are designed specifically to take advantage of impatient retail traders, and they leverage something called theta.
Theta is just time decay. In options, time is a cost baked into the contract. The longer you hold it, the more theta eats away at its value. The big institutions use these opening moves to make the price go sideways, or even slightly against you.
And theta just punishes you for jumping in too early.
It just grinds you down.
Yes. So let's break down the two main traps. I know I've definitely been burned by the first one. The dip and rip.
The dip and rip, it happens right at the opening bell. The stock price falls hard, it dips, and then it violently reverses and rips higher. If you buy a contract and the stock just chops sideways for 10 minutes before it rips,
Theta has already eroded your profit.
it's gone. The stock has to climb even higher than where you bought it just for you to break even. It's incredibly frustrating.
And a reverse of that is the rip and dip, which plays on your fear of missing out.
Exactly. The stock rockets higher at the open, you chase it, you buy near the high thinking it's a gap and go, but instead it pulls back hard and dips, leaving you stuck holding the bag at the top. We also see the gap down and flush.
So, what's the one thing you can do to neutralize all of these traps?
Patience. It's that simple. The strong recommendation from the sources is to wait for the first 30 minutes after the opening bell. Just wait.
Let the noise settle.
Let the noise settle, let the traps play out. You gain clarity, you avoid those impulsive entries, and you get to buy the low instead of chasing the high.
Okay, so once that clarity is there, let's talk entry tools. Charts can get so overwhelming, but we're simplifying this setup here. What are the only 4 technical indicators you really need?
You don't need 15 indicators cluttering your screen. That's just information overload.
Yeah.
The 4 essentials that provide all the clarity you need are the 13 EMA, that's exponential moving average, the 48 EMA, the 200 EMA, and the VWAP.
VWAP, the volume weighted average price.
That's the one.
And what do those EMAs tell you? Why those specific numbers, 13 and 48?
So the 200 EMA defines the major long-term trend. If the price is above it, the asset is generally bullish. The 13 and 48 EMAs show you the immediate and intermediate momentum. When the 13 crosses over the 48, that signals a shift in the short-term trend. The VWAP shows you the true average price for the day, weighted by volume. You use all 4 to define your buy zone.
So putting it all together, how do we define a proper entry?
Entry always means buying on the low. You wait for a clear buy zone, which is often when the price pulls back to one of those key moving averages. You look for patterns like a double bottom to confirm the support, and when the indicators line up and the pattern confirms, you enter.
Enter the low, set your stop loss, and let the discipline do the rest.
That's the whole game.
We've covered a ton of ground today, from future-proofing your wealth to immediate trading tactics. Here are your 5 core takeaways from this deep dive.
Takeaway 1. The big outperformance of GLD and SLV is a critical economic signal. It's forecasting dollar weakness and potential inflation, likely driven by quantitative easing coming around 2026.
Takeaway 2. You need to build foundational diversity in your portfolio. Use broad indices like SPY or VTI, but make sure you also include assets that benefit from inflation, so growth tech like QQQ, commodities, and some crypto.
Takeaway 3. High-yield income ETFs are powerful tools. JPQ with its 10% plus yield from covered calls and DVO with a 4.5% yield can generate consistent monthly cash flow.
Takeaway 4. Trading success really hinges on patience and risk management. Wait out those first 30 minutes of the market open to avoid common traps like the dip and rip that use data decay against you.
In takeaway 5, your technical analysis can be simple. You only need 4 key indicators to confirm your entries: the 13 EMA, the 48 EMA, the 200 EMA, and the volume-weighted average price, or VWAP.
I think the ultimate lesson here is that you have to build a system you can actually stick to, one that combines long-term defensive strategy with short-term tactical patience. That's really the only way to succeed.
The market will always try to shake you out. A good system is what keeps you in the game.
Thanks for listening to the 15-Minute Investor.